How much do you qualify for when you have debt versus when you have no debt? All right, so this is a big thing. I always tell people debt hurts you more than more income actually helps you. So, what we're going to do today at the MBS is do a simple calculation using our HP12C to see much how a car payment and student loans and maybe even credit card debt can affect your buying power and how much you qualify for. All right, so before we started, I just took the liberty of writing parameters on the board here. All right, so what we're starting with is you have 100,000 salary. All right, that's how much you make. What we do, we divide that by 12. So how much do you make a month? You make $8,333 a month. And then, if you remember, we don't want to exceed a certain threshold. Back end ratio, debt to income. All your debts cannot exceed this number. Yes, previous videos you can go above a 40, but trust me, you don't want to go above a 40. So we're going to use 40%. And what this also does is this gives you some wiggle room. All right, in the event that taxes come in high, there's unforeseen debt that we didn't see, and who knows, maybe the rate shoots up before you get to lock in, so you still qualify. All right, maybe you say, I don't want to lock, I want to float the rate, and it shoots up by 0.5%. You're still going to qualify. It's not like you're getting blown out of the water here, and then you got to go to FHA or lose your deposit, what have you. Okay, so you're at $8,300 a month at your gross pay. All right, multiplied by 40% or 0.4 leaves you with a remainder of $3,333. All right, so just say 33333.2. All right, so take out your HP12Cs or just get the app out and follow me here. All right, so I already took the liberty of doing this. I'll do it. You do 100,000, divide that by 12, times that by 0.4. You're looking at 3,333.2. All right, now what kind of debts would say the average first-time home buyer have, or another first-time or home buyer, I should say. It doesn't have to be first time, but for all intents and purposes, a first-time home buyer needs to know this more than, say, a seasoned home buyer that's on their second, third house, or an investor. All right. So let's say, what do you got? You got a car payment. I'm not going to say if it's $700 a month car payment. Let's say it's about $400 a month. Okay. So you take out 400. All right. Let's write that. So you have 400 for your car. We're going to write this in red because it's money going out. Okay, so we're going to say that's a car. And then let's say you got some student loans. You got a nice Ivy League degree. You're not even using it. Let's say your student loans are $200 a month. Okay, 200 for student loans. And then let's say you got some outstanding balances on some credit cards. Now, minimum payment on a credit card is what we're going to use your monthly obligation. So let's say that monthly obligation is between two credit cards. Let's just say $75 a month in credit cards. All right, so 75 in credit cards. Now, this is your debt that's not associated with the home. So now we have this debt. But remember, you're going to pay taxes and you're going to pay homeowners insurance. We're also going to assume you're going to get in one of them special programs I tell you about with no PMI and or you're putting 20% down. All right. So let's just say taxes are about 500. Okay. And then let's just say your homeowners is about 150. All right. That's homeowners insurance. Okay. So let's use our HP12C here. We're going to take out, we already took out your car of 400, your student loan of 200, okay, your $75 a month in credit card payments, and then taxes and insurance equating to $650, okay. So that leaves you with $2,000 to pay for just principal and interest. So what do? We hit PMT. All right, we're going to say 30-year fix. I always want to say to ARM, let's just say 30-year fix as y'all are comfortable with that. 30-year fix is still about 6.375 today, assuming you have good credit. All right, so 6.375 GI, and then 30 years, so 30 GN. That's 360. All right, so what you qualify for with debt, making $100,000 is, gotta write this in blue, is $321,915. So let's just call it 322. All right. So 322. All right. It's actually not that bad. All right. Depending on where you live, you can say that's a good house. If you live in New Jersey, you're going to say that's not buying me anything. Now, I agree with you. So let's work with no debt. I promise you, it's going to be substantially higher in a reasonable debt to income manner. All right. So we have 3,333.2. You have no other debt. All you're going to do is pay taxes and insurance. All right. So from there, same variables, $500 a month. Okay, that's tax. Insurance, $150. And you could probably do that in your head, but for all intents and purposes, and so it's in my calculator, I'm going to take $650 out of that 333.2 number. That leaves you with $2,683.20 for principal and interest. All right, so what do? We hit PMT, same variable, 6.375, GI, and 30 GN for a value of, wow, $430,089. But let's just say $430. So that means you qualify for $430 when you have no debt. All right. Now, why am I telling you this? It's tough not to have debt unless you built up significant cash reserves. I'm not saying you shouldn't lease a car or finance a used car. It just makes your life a hell of a lot harder. Not to agree with everything Dave Ramsey says, but he's not wrong here. Debt is risk and debt is your enemy. You qualify for substantially more when you don't have debt. And you have to understand the reasoning behind why you don't qualify for more. We don't want all your monthly obligations to make you uncomfortable, to make you have to eat rice and beans every day. You can't even take your wife out for dinner. That's how she ends up divorcing you, and that's how you end up paying $4,000 a month in child support if you sell my short. So we don't want to do that. We want to keep monthly obligations to a minimum. All right, that increases your monthly cash flow. It increases your style and quality of life. So by having no debt, all things considered, you qualify for over $100,000 more towards your mortgage. Okay, now I didn't write this. Let's say it's 6.375 on a 30-year. Because obviously these variables are going to change depending on the inputs you select. But this is standard as per today. Today is the 16th of July, 2026. So this is the going rate on a 30-year fixed. Give or take an eighth. You know, again, like I always say, you could probably find someone that's going to chisel that an eighth or a quarter for you. If you have auto debit or relationship pricing with a bank, not a lender nor a broker, you'll probably do better, plus less fees. Definitely watch them fees. You don't want to be paying points. You definitely don't want to be paying origination points. But when you have no debt, you qualify for a lot more. It's super important how you manage your debt and you manage your cash flow. All right, when you say you don't qualify for a lot, it's not because we're bad people. We don't want to see you eating rice and beans every day. You know, go out for a steak dinner, go out for a cocktail. You know, it's summer. Get a margarita. So this is the Mortgage Bro Science. If you know anybody that could find this information helpful, please like and subscribe. Drop a comment. I can do math for you. If you want to see how much you qualify for, you know, I don't even want to do your loan. I just want to help you so you're not getting shafted. Right? I'll do loan estimate reviews, what have you. But remember, debt's going to kill you. All right, you qualify for substantially more when you don't have debt. Also, side note, the reason I use a 40, actually I really like to use a 30%, is because say you don't have debt now. What happens when your car does break down and you need a new one? You're not accounting for another car payment. So then what if you do get a car payment for $700 a month? $700 a month now is greater than the credit card, the student loans, and the car payment. So now you're in the same place that you were. And now if they were to do the mortgage again, your debt to income will be a lot higher. So you need to account for life. When life happens, you don't want to put yourself in a bad spot. Debt is bad. Interest is very bad. So anyway, this is the Mortgage Bro Science. Please like and subscribe.